U.S. banking authorities are now revising policies from the 1970s to combat redlining and increase lending to low-income households. A new proposal would expand the scope of the historic 1977 Community Reinvestment Act to include increasingly common online and mobile banking services. Redlining is when an institution refuses a loan or insurance to someone because they live in an area that's deemed to be a poor financial risk. If proposals are approved, regulators won't just consider the locations of the branches to determine the bank's grade for its lending to low and moderate income neighborhoods. Other requirements for large lenders too will be tightened as part of the reforms. Michael Barr, the Fed's vice chair for supervision, said, and I'm quoting here, the rule maintains a focus on evaluating bank performance in areas where banks have deposit-taking facilities, but also enables evaluation of retail lending and community development activities outside the branch networks. Barr added that the revised guidelines will be easier to understand and implement consistently. But the proposal has been criticized by businesses as well as consumer groups. Many in the banking industry fear that the new standards for assessing loans would make it impossible to get an A grade here, On the other hand, some people think alterations are not substantial enough. Critics argue banks have been rated too readily and low grades might hamper expansion. That's because a bank's capacity to expand that's influenced by regulators' assessments of how well it serves low-income regions. WION is now available in your country. Download the app now. Get all the news on the move.